Why do mortgage rates suddenly spike? Why does the cost of groceries seem to rise overnight? Why do stock markets boom and then crash? Most people assume these things are random, but behind the scenes, one institution has enormous influence over all of it. An institution that doesn't run elections, doesn't sell products, and rarely makes daily headlines. Yet its decisions quietly shape your job opportunities, your savings, your debt, and the price of nearly everything you buy. That institution is the Federal Reserve, and understanding what it does may change the way you see the entire economy. The Federal Reserve, often called the Fed, is the central bank of the United States. Its job isn't to control your paycheck or your career. Instead, it manages something even bigger, the financial environment that affects everyone. The Fed influences interest rates, the money supply, inflation, and economic stability. And through those levers, it quietly shapes the financial future of millions of people. But to understand its power, you only need to understand two main tools. The first tool the Federal Reserve uses is interest rates. Interest rates are the cost of borrowing money. When the Fed raises interest rates, borrowing becomes more expensive. Mortgages rise, credit card interest increases. Business loans become harder to justify. When borrowing slows down, the economy tends to cool off. Companies hire less aggressively, consumers spend less. Growth slows. But when the Fed lowers interest rates, the opposite happens. Borrowing becomes cheaper. Businesses invest more. Consumers spend more. Housing demand increases. Stock markets often rise. Think of it this way. The Federal Reserve controls the speed of the economic engine. Lower rates press the gas pedal. Higher rates tap the brakes. And even small changes can ripple across the entire economy. The second major tool is the money supply. In times of economic stress, the Federal Reserve can inject liquidity into the financial system. This often happens through purchasing government bonds and other financial assets. You may have heard this called quantitative easing. In simple terms, it means adding more money and credit into the financial system. This can help stabilize financial markets, encourage lending, support businesses during downturns, but expanding the money supply can also have consequences. Too much money chasing the same amount of goods can lead to inflation, and inflation affects everyone. It raises the price of housing, food, energy, transportation. In other words, the Fed's decisions can influence the purchasing power of your paycheck. The Federal Reserve operates with two primary goals. Economists call this the dual mandate. Goal number 1, stable prices, keeping inflation under control. Goal number 2, maximum employment, supporting a strong job market. But these goals can sometimes conflict. If inflation rises too fast, the Fed may raise interest rates to slow spending, but higher rates can also slow hiring. On the other hand, if unemployment rises, the Fed may lower rates to stimulate growth, but that can increase inflation. So every decision becomes a balancing act between stability and growth. And here's the surprising part. The Federal Reserve doesn't control the entire economy, but its policies influence the conditions that shape almost every financial decision people make. When the Fed raises interest rates, you may notice higher mortgage payments, more expensive car loans, higher credit card interest. When rates fall, borrowing becomes easier. Housing markets often heat up. Stock markets may rally. Businesses expand more confidently. Fed decisions also affect job availability, investment returns, inflation, retirement savings. So, even if you never think about the Federal Reserve, its policies still influence the financial environment around you. Most people experience economic changes only after they happen. They react to rising prices, market swings, job uncertainty. But people who understand the system can often see the signals earlier. They recognize when the economy is heating up, or when policymakers are trying to slow it down. Understanding the role of institutions like the Federal Reserve doesn't predict the future, but it can make the economic world feel far less mysterious. The Federal Reserve operates mostly behind the scenes. Its meetings rarely dominate daily conversation. but the ripple effects of its decisions travel through the entire economy, from mortgage rates to inflation to job markets. The economy may feel unpredictable, but many of the forces shaping it are not random. And the more you understand how the system works,